Michael Howell, CEO of CrossBorder Capital, an independent investment advisory firm with over 20 years experience in the business. Could you give us a few insights into both the history and the philosophy of your firm?
Yeah, absolutely. We started in 1996. My background was that I was research director at Salomon Brothers, the US investment bank, and then head of research at Barings. And basically we felt there was a need for independent asset allocation advice for investors worldwide. And so we set up CrossBorder Capital. CrossBorder Capital was originally a research company only. We advised on asset allocation, as I suggested, but we've since moved into asset management. Over the last 10 years, we've been running a global fixed income fund, and we're soon to launch an equity fund.
And I guess one of the most important elements of being an advisory firm, but also an investment firm, is going to be communication with clients. How do you interact with your clients and get your messages across to them?
Okay, well, the big thing that we look at is liquidity. I mean, that's our modus operandi, and we're looking at flows of money worldwide. Essentially, what we're saying is, if you know where the money is, if you watch the money flows, you know what investment is going to be good or bad. And so what we do is we track data worldwide on global liquidity. We cover 80 countries. We've been doing this for over 20 years, and we have a large database of capital flow information. And we process that data and we use it to understand the direction of financial markets. So what we do is we produce written reports. We have databases which clients can access online, and we make forecasts of how markets will operate over the next 12, 24 months.
And that concept of liquidity, I mean, in some ways it's at the very heart of the global macro system, but it's something that's quite probably misunderstood or not fully appreciated. What are the elements of the liquidity? What are you actually looking at? And how does that sort of piece together into understanding how it's going to drive asset prices across all the different classes?
I think the first thing to say is that money moves markets. I think everyone would acknowledge that. So what we do is we piece together a picture that starts with what central banks do. So we look at what central bankers are actually doing, not so much what they're saying. We wouldn't necessarily want to believe them. We're looking at their actions in markets. Then we look at cross-border flows. So foreign money tends to be in certain markets critical. Emerging markets are a very good example of that. Money flows into emerging markets often drive emerging market financial markets significantly. And then we look at what the private sector will do in terms of its generation of cash. That might come from corporations building up cash balances. It may be from banks lending. It may be through shadow banks expanding their balance sheets. So all these elements come together and we build up a sort of tapestry of how the global liquidity picture looks. And from that, we can essentially extrapolate how markets will move. Now, the essence of that approach is really to say that the flow of liquidity into markets primarily drives fixed income markets. So in other words, bond markets. It sets the direction of interest rates. The mix of liquidity is much more important for understanding forex markets. So in other words, if the private sector is strong, that tends to be associated with a strong currency. On the other hand, if the central bank is expanding liquidity significantly, you tend to see a devaluation of the currency. And then the third thing is to understand equities, which are probably the more complex of any of the asset classes, because equities are very much a function of emotion as much as the sort of macro space. And so what we're looking at when we want to understand equity market prospects is the positioning of liquidity within investor portfolios. So if there is lots of cash available, equity markets tend to do quite well. If there is low levels of cash and very high equity positions, equity markets tend to do less well looking forward. So we look at the positioning of liquidity for equities, we look at the mix of liquidity for forex markets, and we look at the direction of liquidity for fixed income markets.
And if you are going to sort of put that into layman's terms, does this liquidity, when you look at it in totality, does it equate to things like M2s and M3s, or is it something which is effectively your own model, your own version of liquidity?
I'd say it's a very good question. I mean, it's what we do is we have our own proprietary indicators, and the reason for doing that is that traditional metrics such as the M2s, M1s, or the money supply measures that you cite don't work very well. And one of the reasons for that is the financial system has evolved. So traditionally, if you look at measures of money supply, they are essentially retail-based measures. So we're looking at money in high street banks. Now the world has moved on a lot from that period, and what we do is that we focus primarily on what you would say is wholesale money. So in other words, it's money in the large institutional investors worldwide. It's those type of movements. It's what central banks do, and what's more, it's money that is not in the real economies. M1, M2 are really measures of money that's circulating in the real economies. The money that we're looking at is money that's circulating in financial markets, and what's more, it has a global dimension.
And there you talked about the way that the money is moving around the system. And I think one of the things that's kind of today that people are thinking about, and I guess the big themes for this year, is that we've seen both the fiscal and the monetary coming together. In what way is that one of the most important themes today? In what way is this clash, as it were, or this combination of both the government and the central bank on a global basis? What are those big themes that are coming out of that for 2020 that you're studying at the moment?
I think there are two things primarily, and one is that if you look at the debt accumulation that we've got in the background, combined with what is happening in liquidity, this is a very dangerous cocktail. It's volatile. It creates a fragile financial and economic system. And essentially, we think of what we term a sort of debt liquidity spiral. And effectively, every sort of ratchet, every turn of that debt liquidity spiral increases credit risk in the system and necessitates central banks coming in to try and support things. The problem is that central banks are really operating in the wrong way. And that's the second part of the puzzle. Central banks focus on interest rates. And whenever you get problems, they tend to cut interest rates. Now, the issue really is that if they cut interest rates, they're incentivizing you and I to take on more debt. And that's exactly what they shouldn't be doing. What they should be doing is actually trying to encourage people not to take on debt. They should be increasing the funding ability within the system. In other words, enabling people to roll over their borrowings, but not take out new borrowings. And that's really the fatal mistake they're making. So if you look at central bank policy over the last decade or so, they've actually encouraged the system to become more fragile in the long term, not less fragile.
And you've been characterizing some of this as, on the one hand, you see there's been some disinflation or deflationary forces, and then the reaction to those has been asset price inflationary forces. But actually now that could be combining together to create something which is potentially something we've not seen for a couple of decades, where the inflationary impulse is maybe becoming much more aggressive. Now, is that an inflationary impulse which is good inflation or bad inflation, or is that a transitional phase?
I think that's what you're saying is really the key point. And the one thing that central bankers have really failed to understand is this distinction between good inflation and bad inflation. Bad inflation is monetary inflation. It's destroying the value of money. Good inflation, or good, if you like, good deflation, let's put it in those terms. Good deflation is when the private sector increases productivity and reduces costs. Now, one of the reactions that central bankers have made in the last decade is when they see deflation, they immediately flash warning lights and say, well, this is a bad deflation, it's a monetary deflation, it's what we should be avoiding, and therefore they cut interest rates at that time. That's not what they should be doing. They should be allowing that deflation, because a cost deflation is, as I was saying, a positive feature. It's what the private sector normally does. If you look at the long term, the private sector over decades or centuries creates price deflation. That's how the private sector operates. It wants to reduce costs. The problem is that on top of that, the state tends to create monetary inflation, which is a bad thing. And one of the features you've seen in the last 4 or 5 years is that central banks have basically reacted to price deflation. They've cut interest rates. They've tried to encourage monetary deflation. And as a result now, you look at the growth in monetary aggregates worldwide, you're seeing just phenomenal rates of growth. They are recreating a monetary inflation problem. And that is going to start to appear in 2021.
So with that, moving into 2021, what are the mechanisms that people should be looking for? So presumably this is going to play out in especially currency markets, because as you mentioned earlier, we're seeing a lot of government oversight, shall we say, in the bond markets through these various forms of QE. Is this going to be a currency story? And if so, what are the currency things or pairs that we should be looking for in 2021 as signs that there is a significant liquidity impact playing out?
I think you're going to find actually that the liquidity impulse is going to have effects on all three asset markets, but currencies are clearly a key one. I think if you start at the beginning and look at bond markets are likely to react negatively to all this liquidity. And the simple reason is that bonds are normally held as a safe asset. And if you've got huge amounts of liquidity, which is a safe asset by itself, there's this no need to own bonds. And so investors will migrate into other asset classes, particularly equity markets. Now, equity markets may well continue their good run into 2021, but the sort of bogey for equity markets is a very strong real economy. And one of the things that we think is likely to happen is because of all this liquidity, the real economies worldwide will actually surge next year. As soon as the COVID restrictions are dropped and people will spend the savings they've accumulated over the course of the last 12 months. And that will cause a consumer boom and effectively the economies will begin to move forward very rapidly, but that will suck money out of financial markets and that will adversely affect stock markets. So what you'll begin to see at that stage is a peak and a retreat in stock market indexes. The third area is currencies, and in fact in many ways they may be the most interesting, really from two dimensions. One is that if you look at what's happening to the dollar looks as if it's progressively rolling over. Now, part of that mechanism is that for the last 5 to 10 years, there's been phenomenal demand for dollars within the system. And that's largely coming out, although it's a fairly wonkish comment, because of something called Basel III, bank regulations, which have forced banks, particularly in Europe, to hold more safe assets. Now, at a time when austerity policies have been enacted across European governments, they haven't been issuing bonds. So bunds have actually fallen in the amount of issuance that's out there. Bunds are a key asset for European banks. So European banks have to go to America to pick up their safe assets, and hence demand for dollars has been huge. And that's been one of the factors that's caused the dollar to rise. That demand has now been satisfied. There's actually now a surplus of bond issuance in many European governments, and that's basically detracting from the need to buy dollars. So you're seeing that capital flow ebbing. On top of that, you've got the Biden phenomenon, and with Biden's hands likely tied by a Republican Senate, it's going to be very unlikely he can afford or can put through the sort of spending he wants to enact. Therefore, there's going to be much more pressure on the Federal Reserve to continue to ease monetary policy next year, which will undermine the dollar. Now, the other side of that is that currencies are always two-sided, of course, is what's happening in Europe and what's happening in Asia. If you look at Asian currency markets, or more particularly Asian currency policy, what the Asians have been doing is fixing their currencies to the US unit. So in other words, if the dollar goes up, they go up with it, and if the dollar goes down, they go down with it. And there's been remarkable stability like I've never seen before in the Asian currency markets. Now, if this is a long-term policy, if the dollar devalues in 2021, so will Asian currencies. But what is everything going to devalue against? And the answer are probably two things. One is precious metals and cryptocurrencies, as that block, and the other is basically the euro. And the problem the euro's got is that, one, it's naturally a deflationary currency. So in other words, if you start to see inflation pressures in the world economy, investors will migrate towards the euro with some alacrity. And secondly, it's very difficult, given the policy mix or the policies that the Eurozone adopt, to actually keep the euro down. It's very hard for them to do that. They just simply don't have the flexibility or the range of tools. So we would argue that the euro is likely to appreciate significantly next year, and that may dent the European recovery. On the gold and cryptocurrency question, this is really a long-term issue. And what you're seeing with all this monetary accommodation is that gold is a monetary phenomenon and will rise in value. Cryptocurrencies, and let's focus on Bitcoin because it's the cleanest of all the currencies in that regard, is a substitute for gold. It's a popular substitute among the younger generation, the millennial generation as we know, but if you look at the valuation of Bitcoin relative to gold, it's a very stable 6 times. And if gold goes up, we think gold can hit $2,500 an ounce. You're going to see easily 20,000, maybe 25,000 for a Bitcoin.
And for your clients, a big question will be things like sequencing. What should clients be looking for? What is it that you'll be giving them so that they can watch how these changes start to occur? Because in some ways we're still in that kind of disinflationary weak economy phase, with the things being put into the system, the liquidity put into the system that's kind of gurgling away and ready to go. How will you be looking after your clients and explaining to them how this process and how the framework evolves over the next few months into 2021?
The key thing in financial markets is inflection points. And one of the things you need to look at is the inflection in liquidity. So when liquidity starts to peak, fall, and lose momentum, that's really the time to be extremely worried about the outlook for financial markets. That's when you'll see changes in the direction of financial markets for sure. The other thing to look at is the stash of cash, in other words, the amount of cash in portfolios. At the moment, that's still quite high. It's a healthy level. In fact, it's slightly above normal worldwide. When that starts to go down materially, then you're going to see problems for equity markets.
So 2021, your kind of simple view, your simple summary for clients is?
I think it's one has to be observant of the trends or the cycle. We're likely to see an inflection point next year. Equity markets will do well for the first few months in all likelihood. They're going to have a very, very tricky time as well, the world economy picks up. Bond markets are simply not a place to be. They're far too risky. And if you look at Forex markets, you basically want to be in the deflationary sensitive currencies, things like the European currencies, the euro. Good example, you want to hold gold, that will likely appreciate. You want to hold cryptocurrencies, but I would be avoiding the US dollar. The US dollar is not going to collapse, but it's certainly not going to be a strong currency. And one of the things you tend to find is in periods where the dollar is a weaker currency, the world economy typically does well, commodity prices rise strongly, and actually emerging markets perform pretty reasonably.
Michael Howell of CrossBorder Capital, thank you.
Thanks so much.